All right, Vlad, let's change gears. As a matter of fact, we have our special guest,
Yes.
Dan Deming from the Armor Group. Dan, are you on?
Yeah, I'm
Awesome.
here. Hi, Joe. Hi, Vlad.
I wanted to introduce Dan Deming. He's been on our one of our special guests from Armor Investment Group. And Dan, do you want to share with our audience your view on the volatility last week and in the next couple of weeks? What you think is going to happen in the market in terms of volatility?
Sure.
Yeah, go ahead.
Absolutely. So, yeah, basically, Vlad, what we're looking at is we're looking at the vol. We kind of expect the vol actually kind of hold here. I'm sorry, I've got a little audio delay. Do you guys hear that?
I got
Is
you.
everything
You're
cool?
very loud and clear. That's
Yeah,
great.
we have a great connection.
Okay, great. All right, cool. Good. So what's going on here is that, we're looking at the possibility of rolling it out of October, still expecting vol to stay firm, because the fact of the matter is that the foundation has shifted as far as the market fundamentals, and you're looking at the Fed is no longer in the market at the end of this month. So we do kind of expect the vol base landscape to shift a little bit higher, more normalized type of levels, looking at the mid to upper teens moving forward. So, nonetheless, looking at vol right now, VIX 20, coming off the highs of 30 in the middle of the week last week, you're seeing this downtrend with the market bouncing back. We're looking at the 1905 area in the S&P as a resistance point now. That's at 200-day moving average, coupled with the fact that you got some resistance from the August lows as well. So, we'll see what happens here, Vlad, but right now we feel that vol, based on the movements and the realized volatility in the market, is about fairly priced here, right around the 1920 level.
What I would have to agree with Dan. I believe that heck, last week we saw vol get as high as 24, 25. Now, when Dan...
Spiked to 30.
Yeah, almost 30, exactly. And when Dan refers to the VIX, the VIX, which we brought up, the VIX tracks we call it the cash VIX. Basically, it's the volatility on the front 2 months of the SPX options, and so that's that spot VIX that we talk about, or you hear referenced a lot on CNBC and Bloomberg and Fox and what you read in the newspaper. And what Dan and his group look at is not just the VIX and that SPX. They actually look at the futures. And the futures were pricing in the potential to get up into the 20s, mid-20s, and it's held up here. So I think, Dan, I agree with you. I think that the new norm, which was the old norm, which is in that 19 to 22 range, I think we're going to be back in that range, at least for the foreseeable future, especially in the earnings season in October, which has historically been a volatile month, nevertheless. So
that's correct.
I agree with you, and as a matter of fact, I have vol exposure for my clients. And Dan, I'd like to get your view on this, because I've talked with you and Brian and everybody from your group. I've been using that 4.5 to 1 ratio, which is for every $4.50 I have in equities, I have $1 exposure to volatility. Could you expound on that a little bit for us during this since we are talking volatility? Could you talk about that a little bit more and how you guys approach that as your group and what you do for your funds and for your clients?
Sure, absolutely. A couple things, Joe. I want to give your viewers one reference. You brought out the fact that the cash VIX versus the futures, and a real simple gauge, I think, is, and a great reference that we use and will help, I think, the viewers, is that a VIX level of 16 on the cash VIX basically implies, now this is a general rule of thumb, but basically implies about a 1% move in the market over on any given day over the next 30 days. So, if you kind of keep that in your head as you look at volatility, particularly measured on the S&P or the SPX, it helps give a reference as to what the market's kind of expecting, and it's something that you can use in your analysis of basically positions across the board. It doesn't necessarily, it transfers over to stocks as well. When you look at implied volatility levels on the options, you can take that implied volatility level and basically divide it by 16, and that will give you a general rule of what the expected move is on any given day over the next 30 days. So to use that as a base, what we look at, like you said, Joe, is that we're looking for vol exposure and basically efficient vol exposure to help protect against the possibility of market, movements, dislocations periodically. And we're looking to keep a very consistent level of volatility exposure, which we feel over time gives it's a more beneficial way, I guess, in better words, to stay long the market and still have some meaningful type of alpha producing counter or contrary exposure to the market outside of the fact that the bond market right now, which is typically looked at as a diversifying type of entity, we just don't feel that it's necessarily doing its job right now with interest rates below 4%. So when we look at that 4-to-1 volatility to equity exposure, we feel that that's the best ratio, and we kind of try to keep a consistent ratio for our clients as far as giving vol exposure, taking advantage of these moves in the market to rebalance at key levels to ultimately compound a better return over time.
Yeah, and so you just did my heart really good, Dan, because for the last 5 years, and specifically as we've been doing these videos, we talk about how to calculate estimated moves. And when you were referencing 16, which is basically this, it's the square root of 256 trading days. So you're dividing basically the implied volatility that we see here, multiplying it times the current stock price and dividing it by 16. That'll give you your 30-day estimated move as being priced in by the option. So thank you. I love the fact that, folks, you're hearing an institutional trader talking about how he uses the very things that we talk about and utilize every day. And as a matter of fact, Vlad, that must have made you happy because you talk about putting in your estimated move here too. Like for Gilead, we give you a 30-day estimate. You gave a 30-day estimated move of 980. I just gave you the formula that you can look at with the data, and it's done all right here. And you can see this is an institutional type approach to doing this. So I think it's great.
Well, yes, thank you, Dan, for this volatility, and we're glad to have you this week on our live TV, and we hopefully will see you soon next week and the weeks following. I think volatility is becoming an asset class, and especially if you want to hedge the tail risk of your portfolio, you want to make sure that you are exposed to current volatility. So Dan, thanks a lot for your insight.
Hey Dan, real quick. Okay, thanks. Hey Dan is out, and if you need any information about Dan, about his group, and so forth, you can email Vlad at info@tradespoon.com, and we can get you in touch with Dan.
Yes. And now let's turn our attention to our last segment where we talk about Tradespoon tools. Let's talk about trade idea tools. Right. Especially in the time of heightened volatility, it's very important to find opportunities in the market where implied volatility has expanded. So one tool that we have is a trade idea tool where we actually look at the unusual option activity. When we see institutional trading in specific expiration months, in specific strike price of underlying security, we capture that unusual activity real time, and we show you the top 5, top 10 stocks that have this unusual option or implied volatility jumps.
Let's go through one.
Yeah. So
all right, what do you want to do?
Let's pick ranking model volatility.
Might as well.
Yeah, let's look at the all-time horizons.
Okay.
Risk tolerance, we can leave it at 3. This is medium in terms of implied volatility. And then bullish, and if you click on go, we are real time. We found top 5 stocks where you see Micron, you see Dow, you see Delta Airline. This is an expansion of implied volatility compared to the 52 weeks historical volatility. And right away, we have long-term rating and a short-term trend. So you see there is a spikes in implied volatility in specific expiration months. You look at the time horizon, the number of days tells you what is the expiration cycle we're talking about, whether it's weekly or monthly. And then you have long-term ratings that gives you conviction on the stock. And right away, when you click on Analyze and you see probability calculator, you can actually take advantage of this information and do these as a trace.
Yeah, you know what? Breathe, all right? You were so excited about this. And as a matter of fact, when I look at this, I see short-term, long-term trends, right? So you see short-term, long-term trend. We're looking at this and we're basically going, okay, 9-10, 9-10 being bullish, 1-0 being bearish. In this case, if you look at Micron, this is a great example of how you can go into Micron. This is how I would take it. Buying on weakness, right?
Yes.
Well, you're telling me short-term trend is 1. What does that mean?
That means that Micron has been sold off in the past 2 weeks.
Okay, so that fits my criteria. the other thing is that we're looking at this and we're going, all right, selling to strength. Well, we don't have strength right now in the short term, so I can buy this on weakness. It has long-term strength if I'm reading your rating right now of 10. This could be a great opportunity to then jump down at the probability analysis, look at the target prices through November. Now, there was a 4 for time horizon. What does that mean, 4 days? 4 days?
4 days. So we're talking about weekly options. And
Okay.
we're talking about Friday expiration. We see the unusual activity in Friday's expiration. And probability just tells you if you still can get premium by selling the 24 strike, this is a good trade that has a high probability of success, but also have a high risk. So you want to make sure that you're getting enough premium for that strike price. And if you're not, then you can come a little bit closer to where the stock is trading and sell that trade.
All right, so you know what? Let's do this. Let's jump in here. I'm actually going to take your research. I'm going to drill this down a little bit more. We got Micron Technology. You can see I'm going to the trading block trade builder. Let's say that we have a profit. I'm just going to do something subjective. Let's say 31. There's no math or anything that I've done here. We could do some more analysis, but right now we got 31. We're going to look at November expiration cycle, so that's the third Friday, so that's the 20th. And let's say that I got, $2,000. Fine trade. So what the trade builder is going to do is take this analysis that I did with with Tradespoon, and I basically can start looking at some of the strategies. Now, I may not know what a butterfly or a condor is, so I want to start with the probability of any profit, okay? And I scroll down and I can see either sell put or buy call spread, right? And buy call spread, this particular spread, it gives you the components of the spread, right? And it gives you the probability of any profit, which is 72.6% into November. The great part about this is, Vlad, is that I can take what I've learned at Tradespoon, right? And now I can and take that research, all that analysis, and pop it up here, and I can start looking at the risk reward. And remember, if we go back here to Tradespoon in that analysis, which I believe was right here. Nope, I apologize. Right here. You could see Micron, you have 23 and 34. There's a 95% probability it's going to be between there. Drive a truck through there, folks. So looking at this and wanting to be conservative because we are worried about that short-term pullback, and if there were weeklies in this, we could actually look for a weekly strategy, right? I know that we have the buying the 23 calls, selling the 28s. That fits our criteria. As a matter of fact, I could actually pull this up, click trade, right? And I have a 70+% probability of any profit, right? And as a matter of fact, if you took the debit of $4.27 with the stock currently trading right now at 29 and some change, my break-even point is $27.27. That means that basically I can make almost 80 cents on this particular trade, 73 cents. And if the stock were to pull from 29 down to 27 and some change, Vlad, guess what? We still make money.
Yes.
Right? We still will basically have some profitability. So it's a neat way of how to marry the technology that you have here at Tradespoon, the portfolio analysis, and then actually put it out there in a strategy. So I want to thank you for allowing me to do this. This has been fun. We've been working out some kinks here. We're driving our guys crazy here. We're going, you're going too long. The technology's all over the place. We'll iron out the kinks, folks. But this is fun. This is where you're seeing it real, and we're going to improve on this process. But I want to thank you, Vlad, for allowing us to do this, and you, the viewer, for having.
Thank you, everybody, for participating in our live TV. Please like us on Facebook and Twitter. You will see a lot of updates, blogs, and our views on the market, and our trade recommendation. And we'll see you next week.